Okay, ladies and gentlemen, it's time for another exciting episode of Stacking Adventures. Today is Sunday, January 2nd, 2022. It's a new year and a new season of Stacking Adventures. This is season 6, episode number 1, and the subject today is 2021 asset returns. But first, let's just take a look at this coin that I found while shopping. I got this in change, and let me just zoom in on the microscope here. You can see it's a 2021 Washington quarter from the Philadelphia Mint. It's a P, and if I flip it over, you'll see it says it's the Washington crossing the Delaware quarter. So this is the first one I've got. In fact, I actually got 2 of them, so here's 2 of them. This is Washington crossing the Delaware. There's the reverse side, here's the obverse side. So a couple of new coins I got, and so I have no complaints about that whatsoever. So today's presentation is called 2021 Asset Portfolio Returns. Now, the big story of 2021 was high inflation. The Consumer Price Index rose 6.81% year over year, which is as of November. They didn't get the December numbers yet. And just to cut to the chase, if you don't have time to watch the whole presentation, the place to be in 2021 was U.S. stocks and U.S. real estate. Not precious metals, not bonds, not foreign stocks, not foreign real estate. So let's just talk about inflation here. So you can see that the CPIU, that's the consumer price index for all urban consumers. In November 2020, it was $260, and in November 2021, it was $277. So that means a basket of goods that cost $260 in November 2020, a year later, cost $277.9. 6.81% increase. That's a huge inflation. And it's really hurting consumers. In fact, even today, I went and bought eggs. Usually they cost $1.49, and today they're $2.49. So it's $1 more. So that's like a 50% increase. Something like that. And I also have here the price of a euro in dollars, and which actually went down. So the dollar got stronger, and there's the US dollar index, which went up. But we'll talk about that when we get to the foreign stock stuff. Now, this presentation today, I decided to assign a grade for each of the assets. So just like in school, you had A, B, C, D, and F. And I made A is a 20 to 30% return, B is a 10 to 20% return, C is a 0 to 10% return, D is minus 10% to 0% return, and F is minus 20 to minus 10% return. There's no pluses or minuses except for an A plus if you bought on 30% and an F minus if you are less than 20% return. So now I'm going to get right into the asset classes. So let's go to this page here. So here's the world stocks, bonds, gold, and cash. This is like the 50,000 foot view of the major asset classes. You see that the total world stock index went up 18% total return. And the other asset classes, I have gold here. I have a total U.S. bond market and total international bond market. They all had negative returns. They all lost money before inflation. I remember after inflation, they even did worse, because there was inflation of almost 7%. So the stock market got a grade of B, and gold and bonds all got Ds. Now, a money market fund, if you put $100 in a money market fund, you basically got 1 cent of interest in the whole year. You paid a 0.01% return. And that just barely squeaked by. It's basically a 0 return, but I gave it a C. So let's just move on here and let's look at the precious metals. And you notice here gold, silver, platinum, palladium, all had negative returns. Last year, if you recall, silver had almost like 47% return and gold had like a 25% return. Well, this year, gold was the best of the precious metals, only down 4%, but silver was down 12%, platinum down almost 11%, palladium down 23%. Now, if you go to the copper, physical copper actually went up 26%. So by my grading system here, gold gets a D, silver, platinum, palladium all get Fs, and copper gets an A. Now I also included here Bitcoin, even though it's not actually a precious metal, but I had to include it somewhere. It started the year at $29,000, that's how it ended last year, and then it ended 2021 at $47,000, had a 62% return. So huge gains in Bitcoin, gets an A+. So now let's take a look at the world stock market, comparing the U.S. versus international. The top line is the S&P 500, which got 28.67% return, which gives it a solid A. Second line is the total U.S. stock market, very similar, just includes some more smaller stocks. Got 25.7% return, also gets an A. Meanwhile, the total international stock market only returned 8.62%, which gives it a C. So the U.S. market did much better than the international stock market last year. And now let's just break down the U.S. stock market to value versus growth and large versus small. And well, they all did pretty good. The value and growth both got A's, and the large cap got an A, and the small cap only returned 17.7%, got a B. And here we break down the international stock market, developed versus emerging, and Europe versus Pacific. And you can see that the developed market didn't do too bad, got 11% return, which gives it a grade of B. But the emerging markets did not do that great. They paid a pretty good 2.5% dividend, but they actually lost price. The value went down minus 1.6%. So the total return was like a little under 1%, which is a C. Now, the Europe stock market did pretty good, 16.3%, pretty solid B. And they had good dividend, 3.5%, and the price went up 12.7%. But the Pacific stock market, not so good, only 1.5% return. That's just a C. Now we're going to break down the U.S. market into this is the high dividend versus the dividend growth. A lot of retired people like the high dividend, and and we also do it by U.S. and foreign. And the U.S. high dividend did 26% versus the foreign high dividend did 15%. So there was an A for the U.S. and a B for the foreign. As far as the dividend growth, again, the U.S. did 23%, gets an A, and the foreign stocks did not do as well. They only got 12% return. They get a B. And again, if you look at those foreign stocks, if I go back to this one slide over here, see if I can find the slide here. If you look at the euro versus the U.S. dollar, it's the price of a dollar of €1 in U.S. dollars. In 2020, it was $1.23 for €1, and in 2020 it was $1.13. So the dollar got stronger. In other words, the price of a euro went down by 7.9%. And if you think about that, if you own a foreign stock that pays its dividends in euros, well, when you try and convert them into U.S. dollars, you're going to get less dollars for it, and it's going to hurt the return. So that's what happened. One of the things that happened to the foreign stocks. So let's see if I can see here. So we're moving on here to the. There we go. Here's the sectors. And the sectors is kind of like an old-fashioned way of breaking up the stock market by industry. It kind of makes sense. That's how people used to do it. Now they do it more by value and growth and small and large. But this is sort of an old-fashioned way. So there's consumer staples is one area, and that made 17%, which is solid B. And the consumer discretionary, that's like automobiles, that kind of thing. That's they got an A, 24%. And the utilities, of course, that's the electric company, returned 70% last year. That's a solid B. And the financials did really well. They made 35% last year, which is an A plus. Now, if I move on here to the some more sectors, the U.S. real estate index, these are the REITs, they paid a pretty good dividend, 3.9% dividend, plus the price went up by 36% for a total return of 40%, which is a big A plus. I think this is the highest returning asset after Bitcoin last year. On the other hand, the global ex-United States real estate, while it paid a pretty good dividend of 6.5%, the price actually went down almost 1%. So the total return was only 5.7%. So they get a C. Energy did good last year, 2021, and they got an A. And the healthcare fund did kind of okay. It got 14%. That was a B. Now we're moving on to the fixed income or bonds. And these did not do too good last year. It's definitely not a good place to be investing in bonds. You had dollar-denominated assets all lost money due to inflation. And even before inflation, they lost money. So here's the treasuries. It goes from the money market fund and then short-term, intermediate, long-term. And the return was, for the money market, was about zero, which is a C. Basically, they paid 1 cent in interest for $100. But you got minus 0.87, minus 0.28, and minus 5% for the short, intermediate, and long. They all got Ds, which is not a good grade. And then we look at some more treasuries. These are the extended duration. EDV is a Vanguard fund, lost 6.5% before inflation. That's a grade of D. The only thing that made money last year in the treasuries was the tips, and it returned 5.56%. Still not that great. It's a C, and after inflation, it still lost a little bit of money. It's supposed to keep up with inflation, but for some reason, they don't keep up with inflation. And then you got the Ginnie Mae fund is one of the agencies. These are mortgage bonds, and the total return there was minus 1.1%, which is a D. So nothing good there in the treasuries. Even the tips didn't totally keep up with inflation. Okay, now we look at the tax-exempt money markets. These are better than the treasuries. Again, we look at the money market, the short, intermediate, and long term, and they all were just slightly above zero. You got 2 cents return on the dollar. Now, this is kind of strange. Usually, the capital return is zero for money market funds, but Vanguard showed it as a 1 cent capital return. So usually the price stays $1, but I don't know what's going on there. But the short, intermediate, and long term made 0.17%, 1.1%, and 2.26%. And finally, the high yield tax exempt wasn't really that high yield. It paid an interest of 3%, and it made about 1%, but you made about 3.95%. And all of those get C grades. And then you get to the world of corporate bonds. Corporate bonds are supposed to pay higher interest than the treasuries because they're higher risk, right? There's always a danger there. They could go out of business and not pay their bonds. Well, guess what? They didn't do too good at all. The short-term, intermediate, and long-term got minus 0.43, minus 1.48, minus 1.16, all Ds. The only thing that made a profit at all was the high-yield corporate, which is supposed to be the riskiest ones of all, made 3.68%, which gave it a C. So terrible bond market last year. So now we're going to turn our attention to balanced funds. And these are always good because they're more in line with what people actually got who invested, because no one invests 100% in the S&P 500 or in the total world stock market or in gold or anything. So a 60-40, the balanced index fund, a very low dividend, 1.6%, but its capital return was 12.6%. So the total return was 14%, which gives it a solid B. So not too bad there. Then you get these target retirement funds and Wellesley Income. They got 5% and 8%. So they're just in the C range. Not so great. Not too bad, but not that great. There's also a global Wellesley, which invests in some international stocks. and that did a little worse than the U.S. Wellesley, which so 6% for the global Wellesley. The Wellington Fund, same managers as Wellesley, but they have instead of 40-60 like the Wellesley, it's about 2/3 stocks. That got 19% return, and even the global Wellington got 13% return. So they both got Bs. And now we turn our attention, this is the last thing, we're going to look at the asset returns, the lazy portfolio returns. And lazy portfolio returns are portfolios that these experts are recommending. And it's actually not a bad thing to, you go buy a book by one of these guys like Andrew Tobias or Bill Bernstein and read his book and then maybe invest according to his plan and usually do pretty well. And you notice here, I've got about 6 of them listed here. Andrew Tobias, Bill Bernstein, Bill Schuthice, Coffee House, Boulderheads, David Swenson, DFA, that's Dimensional Fund Advisors. They all got Bs. They're all in like 12, 13, 14, 17% return. That's about what you got if you're a lazy portfolio investor. So, but let's look at the next page here. There is a couple that did a little better and a little worse. The first line there, Larry portfolio, Larry Swedroe, he only made 3.4% last year, which gives him a C. And at the bottom there, the Harry Brown portfolio only got 4.2%. He got a C. If you look at his portfolio, it's got 25% of stocks, bonds, gold, and cash. And you know that cash made 0. Gold had a loss of like 4%. The bonds had losses. So the only thing that made money was the stocks. So 25% of his portfolio made money. The rest either had no return or lost money. So he only got a C last year. And these other guys here, Mebane Favor, whose Ivy portfolio, he got a big 22% return this year, which gives him an A. But if you remember last year, if you look at last year's report, he actually did pretty poorly last year. So some of these people that get like A one year may get a D the next year. I'd rather get like if I go back to the previous page, I kind of like these guys where they get a B like every year. I'd rather get like 15% every year than to get like 1 year you get like 30% and next year you get 2%. Finally, we got the Warren Buffett portfolio, which is 90% stocks, and he got 25% return last year. Gets an A. In fact, you could have also invested in his Berkshire Hathaway Corporation, and it got an 28% return that way. So that's the report this year. The 2021 asset returns, portfolio returns. Most people did pretty good because if you had a lot of stocks, you did pretty well. People had a lot of bonds, didn't do so great. People had precious metals. Well, those prices just went down last year. So anyway, good luck everybody in 2021 and 2022.